In today's episode, I'm going to teach you how to find penny stocks to trade, where to get in, where to get out, and how to manage risk on these stocks, which are some of the most volatile stocks in the market. Today is day 6 of my small account challenge using a cash-only account with Thinkorswim. And of course, today I traded penny stocks, which is why I thought it was a great opportunity to teach a full-length class on a step-by-step guide on how to approach penny stock trading. Now, to give you some context and to introduce myself, my name is Ross Cameron. I'm a full-time trader. I've been doing this full-time for more than a decade. But when I first started trading and got interested in the market, it was during the dot-com bubble of the late 1990s. Now, when I funded my first real money account 23 years ago, it was with $1,000, and it was actually with an Ameritrade, the Ameritrade broker, before they merged with TD and became TD Waterhouse. And then eventually, of course, they merged with Charles Schwab or got bought out, whatever the case is. So in any case, when I first started trading, you know what kind of stocks I traded? I bought large cap stocks. I bought stocks that I was familiar with. So with $1,000 in my account, I bought shares of ExxonMobil, Pfizer, Caterpillar, US Steel, American Electric Power, a couple other stocks. And I did it in June at the beginning of summer break during high school. And by the end of summer, you know what happened? The account was more or less unchanged because I ended up investing in companies that don't really move that much, which is good. I suppose if you're investing maybe with a pension fund or mutual funds and you're looking for sort of slow, steady growth. But with $1,000, my goal was to grow the account quickly. So for this current small account challenge that I'm doing, my goal has been to grow the account to $25,000 and to do it as quickly as I can. And so naturally, I need more volatility. Now, as a full-time trader for the last 10 plus years, I've been focusing on trading some of the most volatile stocks in the market, including penny stocks. But for this challenge, I need to take it up a notch and trade some of the ones that I think have the potential each day to go up 50%, 100%, or more. So let's go ahead and jump onto the screen share. I've got a slide deck for you. We've got our whiteboard. We've got a ton that we're going to cover. And of course, today is day 6 of the small account challenge, which means I took some trades. So I'm going to have to update you on progress of where that account is at right now. But let's go ahead and first, we'll look at these two stocks right now. This one on my chart, KAVL, this stock is up over 200% today. 200% in one day from 60-cent low right there up currently at $1.85. And that was one of the ones that was really volatile. And TGL currently is up 88% on the day. This is a stock that hit a low of, it was about 90 cents down here before rallying back up 83 cents before coming back up to a high of $1.40. Now, this is actually the one that I took my trade on. I would have been happy to take a trade on KAVL, but I can only take one trade per day in a cash account if for each trade I use all of my buying power, which is exactly what I'm doing. And that's part of the strategy that I'm going to share with you today for account growth. Now, I should probably tell you, this I think goes without saying, but I'll say it anyways. Trading is risky. Trading penny stocks is very risky. And I've got a lot of experience trading in the markets. So I don't want you to think that my experience is typical or that you're going to watch an episode like this and then tomorrow be able to triple your account, because that's not realistic. Learning how to trade takes time. But here's the deal. I will share with you the strategy that I use for finding stocks, for entry and exit, and for managing risk. What you need to do is bring to the table the dedication, the discipline, and the drive. So if you could do that, now let's go ahead and jump into today's class. All right, I'm going to pull up my slide deck here. So here we go. So a beginner's guide to trading penny stocks. We're going to go full screen on this slide deck. Now, penny stocks, we have to kind of define what this actually is. Most people would think of a penny stock as a stock below $1 a share. But in fact, the definition as made by US regulators is that a penny stock is a stock trading below $3 a share. I know that seems kind of funny because you wouldn't, $3 a share is not a penny stock by the literal definition. In any case, that's the definition by regulators. I would tend to kind of lean more towards penny stocks being stocks that are literally under $1 a share, but nonetheless. So that's the definition. And of course, by that definition, I am often trading penny stocks. I usually focus on trading stocks between about $1.50 and $10 a share. Now, what I can do for you real quick is I could just show you, give you a glimpse at my metrics so you can see the price range stocks that I'm typically trading. All right, so this is going to be Let's see what filter I've got applied here. So we're going to look at this. I'm going to take away this time frame. So this is going to be about $13.2 million of total gross profit. And we're going to scroll down. These are all of my trades. We're going to look at price and volume. And you'll see right here that I am primarily trading lower price stocks. Under $2, not as much. 2 to 5, a lot. 5 to 10, a lot. 10 to 20, quite a bit. And then above 20 to a lesser extent. Now, I think one thing that may surprise you is why, for someone focusing on growing an account, which I've always been focused on with various small account challenges, I don't trade more of the really cheap stocks. And you're going to learn the answer to that question as I go through this class, because the answer is related to pricing and how the quotes work on penny stocks. All right, so the minimum tick difference between a stock under $1 and above $1 is what I'm getting at here. So stocks that trade over $1 a share trade in a 1 penny increment, which means, just to say it in plain English, if a stock is trading at $1.17, the tightest the spread could be is $1.17 by $1.18. $1.16, $1.17, $1.17, $1.18. You'll notice that when stocks trade above $1, they don't trade down to the fraction of a penny. They don't trade by $1.17.5 by $1.17 for instance. You don't split pennies. I mean, we can't split pennies. In the real world, you always round up the penny, right? But what is interesting is when it comes to actual penny stocks below $1 a share, you can split the penny. Isn't that weird? So you could split the penny, and you can actually split it all the way down to the 1/100th of a penny. Holy smokes. And this is kind of crazy when you think about it. So we got to get the whiteboard out here. So if we have a stock that's priced at $1, and we're looking at it and we're thinking, all right, I wonder if this stock could go up to $1.10. In order for it to go from $1 up to $1.10, it has to go up 10 cents a share to $1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there are 10 cents between $1 and $1.10. That goes without saying. But for a stock to go from 90 cents to $1 a share, it's also 10 cents. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? But each penny can trade to the 1/100th of a penny. So that means you actually have 100, 100, 100 increments, which totals out to 1,000 price increments from 90 cents to $1. So when we look at this stock right here on the depth of market, you can see the current quote is 47 and a 14th of a penny by 47 and a 19th of a penny. So it's trading down to all the way down to the 1/100th of a penny here, which is kind of crazy. So when you look at this market depth, you can realize, wow, it's actually going to take a lot of buying for this stock to go from 47 cents just to 48 cents. It's not just 1 penny the way we would think of it. It's 100 tenths. It's 100/100ths of a penny. So all of a sudden, these stocks move that much more slowly. And so one of the things that happens as a result of this is a lot of traders, when they trade penny stocks, they'll see a penny stock at, let's say 40 cents a share. And they think, well, I want to buy this. I want to buy, 100,000 shares of it. And if they buy 100,000 shares, if you do the math, when you're trading a stock, if a stock goes up 1 cent and you've got 1,000 shares, you're up $10. If you've got 10,000 shares, you're up $100. If you've got 100,000 shares, you're up $1,000 for every penny. If you've got 1 million shares, you're up $10,000 for every penny. For every single penny that the stock goes up. And so if you bought 100,000 shares of this at 40 cents, you would instantly be down 1,000 if it was 39 by 40, right? So it's kind of like, oh gosh, 100,000 shares, that's too much risk. But if you buy this at 40 cents and the current bid is 39.95 or something like that, then you're not risking that much. And so the result is that most people who trade penny stocks end up trading with massive positions, 100, 200, 300, 400, 500,000 shares. And they're not risking typically $1,000, $2,000, $3,000 just between the spread of the bid and the offer, right? Because of the ability to split the penny. So the result is people take huge positions. And when people take huge positions, then when we're looking at the level 2, what ends up happening is the stock becomes very congested. And so if we look at a stock with the bid and the offer, and let's just say it's 39.95 by 40 cents right here, you might have 500,000 shares on the ask and 500,000 shares on the bid. You've got these huge stacks of huge buy orders, huge sell orders, because there's so many people that take big positions. And so this results in a stock that becomes very thickly traded. It doesn't move very fast, typically, when they're below $1 a share. And then suddenly, once they're above $1 a share, you drop those decimals and we're going back to just trading, $1 by $1.02. And next thing you know, in a fraction of a second, this could be at $1.12. And with 500,000 shares, you're up big, right? You're up $50,000 in an instant. And then next thing you know, it's at $1.25. It's at $1.35. It's going up faster. It's at $1.80. And maybe someone who's short is suddenly down $500,000. So when we go back and we look at a stock just like what we had today on KAVL, let's see, where's my chart? Okay, so we look at KAVL and you look at how fast this stock moved from 80 cents to, once it got over $1 a share, I mean, it was just like on fire. Boom, it breaks $1 and it's just straight up to $1.50, pulls back up to almost $2. This is where things start to really get exciting. So what I've learned is that generally the place I get interested in penny stocks is when they're in the range of 95 cents, and they look like, to me, the chart is set up well for the break through $1. But even going from 90 cents to $1 is still like that final push. So the safest thing for me typically is to wait for the stock to break $1. And then once it's above $1 a share, then at that point, I know that it's going to trade generally a lot faster. Now, it's also true that all of the orders that are out there are going to end up settling at 1 cent increments. So if there are people that accumulated huge positions to the hundreds of thousands or millions of shares when the stock was below $1, they may take profit once the stock is above $1, and especially as it starts moving higher. And so that can take the form of large sellers creating resistance. And that's something that you just don't see when a stock begins its move at $3 a share. If a stock has breaking news and it starts at $3 a share, no one had the opportunity to easily accumulate 100, 200, 300,000 share positions while only risking, a couple hundredths of a penny. So when you have higher priced stocks like that, when they start to move, they typically won't have really big sellers blocking the way. And of course, they trade above $1, so they have a regular 1 cent spread. So for that reason, my sweet spot is a stock above, usually in the $2 to $3, $4 price range that has breaking news, and then in an instant is going up to 5 to 6 to 7 to 8 to 9, and we get the 100% move right there. So that's why you see that that's the area where I actually make the most money. But let's jump back onto the slide deck and talk a little bit more about penny stocks. So one of the kind of big issues that we have with penny stocks is that any stock below $1 a share will trade down to the 1/100th of a penny. So that means these stocks can be very thickly traded and they could be slower moving. Now, the New York Stock Exchange and NASDAQ, in fact, require that all companies keep their stock above $1 per share. If the stock falls below $1 per share, a company will have a certain amount of time to get the stock back above $1 before they risk a trading suspension and getting delisted from the exchange. They can actually get delisted from NASDAQ or from the NYSE exchange because the price wasn't above $1. Now, one of the flaws with this system is that a company is usually given a period of time. So let's say, for instance, you have a low price stock, and this happens all the time. Let's say you have a stock that IPOs at $10 a share. So they sell, and let's just say for the sake of argument, they sell 5 million shares at $10 a share. So 10 times 5, so they raise that money, boom. So they've got 50 million bucks that they've raised, $50 million, which is great. So they've raised some nice money on the IPO. And from this point forward, this is the number of shares available to trade. So the company IPOs, this is the stock chart. It's day one. And then over the course of the next 6 months, the stock just drops down. Which is not uncommon, especially with a small cap company. So let's say it goes all the way down to 10 cents a share. So now the company has a real problem. And let's say they drop below $1 real quick. So now they've been below $1 a share for a couple of months. Now, what's going to happen is they're going to get a letter from the exchange. This was the $1 mark, just for instance. They get a letter from the exchange, and the exchange says, hey, you have 90 days to get your stock back above $1. And now the company can do a couple different things. The first thing they could do is they could appeal it. And if they file an appeal or ask for an extension, that'll give them another 90 days. So now they've got 6 months, basically, just to kind of do nothing, but hope that the market starts to like their company more. And maybe if they put out some good news and they become a better company, that'll happen. But assuming that doesn't happen, the price is going to continue to go down. So let's say it goes down to 5 cents a share. So then at this point, the company's at 5 cents a share. They've done everything to turn the company around. It can't go up. And so they do what's called a stock split. But it's not traditional stock split. It's a reverse stock split. So if they did a 10-to-1 reverse stock split, then the price would go up times 10, which would be to 50 cents. That's not going to work. So they're going to do a 100-to-1 stock split right here. And they're going to bring the price all the way back up to $5 a share. So now the stock is back at $5 a share. Boom, overnight, back to $5 a share. But imagine you held all 5 million shares at 5 cents, and the next day it's at $5 a share. You're rich, right? Well, not so fast. So they're actually going to reduce the number of shares available by the same ratio of the split. That way the market cap is unchanged. So 5 million shares times 5 cents, and then $5 times, what's the ratio? So it's not 500,000 shares, it's 50,000. So it would go down to 50,000 shares available to trade at $5 a share. So that's what would end up happening. Now, what then typically happens is the stock puts out some headlines and squeezes pretty fast up to about $15 a share. Because when you've got a 50,000 share float and a company that has breaking news, you've got a very low level of supply. The number of shares available to trade is the supply, and then the demand comes from the news. So now the stock goes up to $15 a share, and the company says, you know what? Well, we really do need to raise some more money so we can keep, growing this company. So then they say, let's sell, 3 million shares on the open market. And they say, well, we can't find anyone to pay $15 a share. And say, well, whatever, let's just sell 3 million shares at $5 a share down here. Who really cares? If we can get if we get the money, we'll get the money. So 3 times 5, so they raise $15 million, and then the offering's at 5, so the price comes back to 5. But what they've effectively done is cashed in $3 million. That gets to go, boom, right here. They've sold some more shares, and now it's probably going to happen over the next 6 months as the stock is going to go back down again. And then they'll do the same thing. So this is the cycle that a lot of these companies are taking part in. For us, as active traders, this is the spot where we find opportunity. We find opportunity right here because the company has put out news. That's typically what ends up happening. And so a lot of these stocks that we look at, the ones from today, let's just look at the charts from these ones today. What I think you're going to notice is that these are stocks that generally have been beaten up for quite a while. So let's look at KAVL first, and we're going to look at the daily chart. This is one of the things, though, that I really love. So this is a stock that literally hit all-time lows of 52 cents yesterday. This is the lowest that the stock has ever been. So this is a stock that's been getting really beaten up. And if we look at our stock chart, you see the S. That tells us that this is a company that's done reverse splits. This one was 12-to-1, and this one here was 21-to-1. So they're playing the game. They're doing the splits to keep the price above $1 a share. Every time it drops below $1, they risk getting the delisting notice. So they do the split. The price comes above $1 a share. They get a high boost of volume on that day, which is an opportunity where they could sell shares on the open market if they choose to. This already has 80 million shares of volume today. Yesterday, how much volume did it have? 139,000 shares. How's the stock go from 139,000 shares to 80 million? Breaking news. They put out breaking news. Next thing you know, the stock's at 50%, 70%, 100%, and active traders are jumping on to ride the momentum. And look, you never know how high it's going to go. On some of these moves back here, it went from 50 cents all the way up to $8 a share. That's a huge move, over 1,000%. You get some of these big moves. I mean, next thing you know, this stock has news and traders are jumping on it fast, looking to see, is this the next one that's going to go up 500, 600, 700%? We look at the other stock, TGL, and this is a stock that very similarly, somewhat recent reverse split back here. Oops, right back there. So the split on this one was 70-1, which is a big split. It hit basically all-time lows again yesterday, and then it squeezes from that low point up to $1, whatever it is, $1.30. These are really impressive moves. So these are one of my favorite setups to trade. Now I'll show you another setup just for a second, just to kind of compare it. This is a stock, no, not this one. Let's see, LASE. LASE. This is a stock that is doing a little bit of a different setup. You see how this stock has been sort of generally moving higher? It's kind of just, it's like pulls back and then it squeezes higher. In fact, in a lot of ways, you look at Tesla and Nvidia during periods of momentum, their charts look kind of similar. Just steady, strong momentum. It just pulls back and then it goes higher, pulls back and then it goes higher. That can be a very strong daily chart for continuation or trend trading, but I usually find the most dramatic moves come from stocks that were just at all-time lows and are now reversing off of that level. That's where I usually see these really big dramatic moves. So now we've talked about the reverse stock splits and that being a technique that these companies use to keep their price above $1 a share and maintain compliance. But if a stock is ultimately not able to keep their stock above $1 a share, then they face the risk of being delisted. And currently, there's some movement by regulators to actually put an end to this small cap cycle of reverse split, secondary offering, reverse split, secondary offering, because they feel it's unfair to investors, and it is kind of an unfair practice. So they are talking about restricting the number of times a company can do a reverse split before they are told that enough's enough. You've got to, if you can't stay above $1 without doing another reverse split, you either have to be a better company, number one, or number two, you're going to get delisted and you're going to move to the OTC market. So when a company gets delisted from the NYSE, NASDAQ, American markets, then they can go to the OTC market. It's called OTC. It's called over the counter. And although I suppose in a way, all markets were over the counter at one point in the sense that you actually had to go to the floor of the exchange and a market maker had to place the order. The over-the-counter market, the OTC market, still has stocks that trade like that, where you actually to place an order, you might not be able to place it through your regular broker. They would restrict it, so you have to kind of use these other channels. So the OTC market is actually broken up into different tiers. It's run by the same exchange, but they have separated tiers within the market. The top tier is called the best market. And so the OTC QX here is best market. And these are the stocks that face higher financial standards and must demonstrate compliance on multiple fronts. So they may not be yet a NASDAQ or a NYSE listed stock, but it's a company that maybe is hoping to uplist and move up to the big exchanges. Now, some companies downlist because they get delisted, but others will uplist and they'll move up. So a best market is a stock that's kind of right on the cusp. They may be hoping to move up to NASDAQ or NYSE, they just haven't done it yet. And then you have the OTC venture market. The OTC venture market, these companies have to be at least 1 penny per share. Now, what you may recognize is that if the minimum spread, the minimum tick is 1 1/100th of a penny, then in fact the lowest price a stock could trade at would be 0.001 by 0.0002. That would be the very lowest price stock in the entire market. And those stocks do exist. But in order to be on the OTC venture market, companies must be at least 1 cent a share. And the company cannot be in bankruptcy. There's also other requirements for annual reporting and certification. So these companies are more transparent. Their ownership is more transparent. And, so that's sort of the second tier. And then the third tier are the pink sheets. Now, if you've heard of the pink sheet market, and you may have if you've watched Wolf of Wall Street or some of these other movies that talk about penny stock fraud, pink sheets, these are companies that can, not all of them, but they can be very shady. They don't have very clear ownership structure. They may be owned by a shell company that's in some country that has has really tight privacy, like, I don't know, Panama or some of these other companies. So the actual owners of the company are very carefully disguised. There are probably foreign nationals who are using this as part of some pump and dump scheme. They're using social media and WhatsApp and Telegram and all these different apps to, put out these alerts. And we've seen this a lot with some of the Chinese pump and dump stocks that are actually on the NASDAQ market. But in any case, it happens on the OTC market as well. So pink sheets are, some of these stocks are among the worst in the entire market. And the pink sheets are actually divided into subcategories. But nonetheless, a pink sheet stock can be as low as 0.0001, which would make it what's called a trip zero stock. So as you know, a traditional penny stock would be a stock that's trading between 1 cent and between 1 cent and 99.99 cents. That would be a traditional penny stock, right? Now, a sub penny stock would be a stock below 1 penny a share. So if a stock is below 1 penny a share, you can see the level 2 over here. It's 0.003, so it's a third of a penny, by 0.009. So that's a sub penny stock. Now, a trip zero stock is a stock that has 3 zeros, a 000. They're priced 0.0001 to 0.0009. And the thing with some of these companies is that some of these shell companies will issue billions of shares. And so insiders hold all of these shares. And if they can get the trading price to go from, from 0.001 to 0.009, it's already up 900%, right? If they can get it to go up to a penny a share, they can make a tremendous amount of money. And so that's why some of these stocks are used in those schemes. So this is the chart of a 000 stock, and this is usually what they look like. They just basically go sideways, right? And these are shell companies. Usually they have no real volume. There's no liquidity. You can't get in. You can't get out. It's just the very bottom of the market. So for me, and especially for this Thinkorswim small account challenge, while on the one hand, it would be amazing to grow the account by 500% in one day, realistically, I would have to take a unreasonable amount of risk to achieve that. So now we've got to talk about how to find the right penny stocks to trade, where to get in, where to get out, and how to manage risk so I'm not worried about losing 50% of my account in one day, because that's a risk that I right now cannot tolerate. With this account that I created, this cash only account, I cannot add more money to it. So what's in that account is all I have to work with. So that's that's part of the rules that are set forth for this account that I set up. So I've got to be able to grow the account without risking losing, half of it or something like that. So this is my approach. I'm going to look for and hunt for volatility, but with less risk than the traditional penny stocks that are under $1 a share. By focusing on NYSE and NASDAQ listed stock, I'm reducing the risk of the OTC market. By focusing typically on stocks between $1.50 and $10 with floats of under 20 million shares. And the float is the number of shares available to trade created by the IPO and then subsequent reverse splits that can change it. But preferably, as I said, under 10 million a share, I can benefit from volatility while being able to manage my risk. Because at the end of the day, I have to be able to manage risk. So one thing that I often say is that as an active trader, I'm a hunter of volatility and a manager of risk. I don't make money buying a stock at 5 and selling it at 5. I need to find something that is moving, but I always have to ask myself, how much am I risking? If I start trading thinking only about profit, I would say that is effectively gambling because you're not thinking about your downside risk. And downside risk is, it's a reality of trading. There is no such thing as a trader or a strategy that is right 100% of the time. And if we back up here and just pull up my metrics, we can look at my accuracy. So what's my accuracy? This is over, 28,000 trades. Accuracy is 68%. So this goes to show that's $13 million of gross profit with 68% accuracy. You don't need to be right 100% of the time to make good money in the market, but you need to know how to cut your losses relatively quickly. And ideally, you want to be right more often than you're wrong. That is preferable. All right, so we're going to talk here about steps to reduce our risk. And for me, it all comes down to stock selection. That's really my belief that if you're choosing the right stocks to trade, you're greatly reducing your risk. That's the first step. So if our first step is to reduce risk by choosing the right stocks, we're going to say step one is stock selection. So what I'm actually going to do for you guys is I'm going to put a PDF in the comments. I'm going to put a link where you can download the PDF in the comments. It'll be linked to the top comment and it'll be linked in the description so you guys can download it. There's, I have a selection of downloads as part of this Thinkorswim small account challenge that include my stock selection PDF, my micro pullback strategy PDF, and my Thinkorswim layout. So you get all of them in one download. I think that we have to outline, and I'm going to start to define what the right type of stocks are. And so I'm going to jump back out of this slide deck here. I'm going to move this up here for a second. And what you're going to look at here on my screen share, this is the software that I've been using for my own trading now for quite a long time. This is called Day Trade Dash. And this is software that I've created with a development team that work for me. And this is the software that many of our members at Warrior Trading are subscribed to. So Day Trade Dash is my whole vision with creating this was that it would be the ultimate dashboard for active traders, and that this would be the software you would use to find stocks that are moving every single day and to analyze them and to make your decision of whether or not you're going to take these trades. So step one is that we've got to find a stock that's moving. We don't, as we said, make money buying a stock and selling it at the same price. So we need to find a stock that's moving. So my first step every single day, and today was no different, is to pull up my scanners and to look at what's moving. Now, something that I did this morning, which is a little bit different, for those of you guys who have been tuning in to my recaps from the last week, you'll know that I had a red day on Thursday and then Friday as well. So I had small red day on Friday, but 2 red days in a row. And so I said, okay, for Monday morning, I really need to turn around. I need to slow down. I need to focus on quality over quantity. High quality setups, 1 entry, 1 exit, get green, get out, shut it down. Don't overstay your welcome. And so I said, I don't want to pull up my scanners the second I get out of bed, because sometimes when I pull up my scanners on my phone, the second I get out of bed, I'll immediately feel a sense of FOMO, the fear of missing out. Like, oh no, I already missed a move and I got to run over to my office as quick as I can. But I first have to get my kids ready for school. That's part of my morning routine. I'm a parent. So I've got to get my 2 kids ready for school and then come over to my office. So I said, I'm not even going to look at any scanners until I come to my office. So I came over to my office, I sat down here, and I saw TGL was our leading gapper. Now, TGL, as it turns out, was the stock that I put on my watch list for today based on my weekend scan that I ran last night. So I already kind of had this on watch. And the reason I had TGL on watch was because it had made a big move Friday after hours. So it had news that came out after hours on Friday, and that resulted in this initial squeeze up. Now, I wasn't sure whether or not it was going to continue, but it pulled back and then it kind of rallied back up, as you could see right here. So I ended up breaking the ice and taking my first trades on it as it curled up right here. So the way I found this stock was it was on my scanners, and this is how I analyze it. So this scan right here is called a top gainers scanner. So it is searching the entire market and it is sorting all of the stocks in the market from the leading percentage gainer first. And it shows the top 50. So the top 50 leading percentage gainers in the entire stock market. So right now, at this moment, KAVL is the leading percentage gainer in the entire US equities market, up 153% with 91 million shares of volume. And TGL is the second, up 93% with 99 million shares of volume. So I'm looking first at the percentage of the gap. Now, if I pulled up my scanners and I saw that the leading gapper was, let's just say down here, it was only up 9%, I would think to myself, shoot, 9%. That's not a very big gap. For me, I would say at a minimum, and we'll start outlining some of the stock criteria, and you can again download the PDF in the description, and then you can print it out and you can have this in a nice organized form. So number one, we want to see that the change is up at least 10%. That is an absolute minimum. If the stock's not up 10%, it's not really breaking the standard deviation of the market. We need to see big percentage moves. So 10% minimum. And to be honest, I would say 40 to 50% is preferable. So that's like, plus plus. Some people would say, gosh, Ross, you can't buy a stock that's already up 40%. It's too extended. And here's what I would tell you. A stock that's up 40% has a much higher likelihood of going up another 10% than a stock that's up 0 has to going up just 10%. In order for a stock that's up 0% to go up 10%, it needs breaking news. In order for a stock that's already up 40% to go up another 10%, all it needs is a nice chart pattern and for people to continue to like it. And if the stock is holding up well, the price action is clean, then that's the candidate that you're going to want to focus on. That's the one that has the potential to make that continued move. So being up 50% or 40% is not too much for me. All right, so number one, stock's got to be up at least 10%. Now, number two, I look at the price. And I prefer price to be under 20. But for this small account challenge, I really can't afford to trade stocks that are $15, $20 a share. So for this small account challenge, I'm saying the price has to be under 10. But is there a minimum price, right? Under 10, but above something? Generally, right now, I would say probably above 75 cents a share. And the reason I'm saying that is because I'd really prefer to trade stocks that I think have a good shot at breaking over $1 a share. So below $1 a share, because of that issue that we have with the 1/100th of a penny tick, I would prefer not to trade it too much. But at a minimum, I would say 75 cents and maybe, probably not lower, but it's sort of 75 cents at a minimum. Okay, so when I first pull up TGL this morning, I saw that it had pulled back down off of its highs from yesterday or from Friday, and it was down just under $1. And I thought, this is okay. I can work with this. This is a price range that I think, we can do something with. So we'll back this up. So then the next step is verifying, so a couple more steps. So number 3, I like to confirm that there is news. All right, that's preferable. And I checked TGL, and so I'm like, all right, is there a news headline? What was pushing this stock higher on Friday? Number 4, I like to check the relative volume. So relative volume is an indicator that measures today's volume and then compares it to the average volume of the stock over the last 50 days. Now, you could use different time periods. You could use 14 days if you wanted, or 21 days. But what you generally want to see is that the stock currently is trading on much higher volume than is normal. And so our relative volume rate here for TGL is actually 2,946 times higher than average. That is huge. And you can see KAVL is also high. KAVL is higher, but they're both high, and they're both acceptable, and they're both candidates for trading. And I traded both of them today. Only one of them in the small account, but I traded both of them in total today. So the next thing is we confirm, relative volume on this one. So then if we look at TGL, so TGL stock, we're looking at how much it was up. I think it was up something like, oh gosh, it must have been up like 70% when I first looked at it, or something like that. The price was about 90 cents. So 90 cents. News, I said, we've got the catalyst there. Relative volume, it's 2,900 times higher than average, so that's fine. And then number 5, I'm asking myself the float, which is the number of shares available to trade. I prefer under 10 million. I check the float on TGL, and we could see right here it's 806,000 shares. So definitely meets and in fact exceeds that lower is better in this case. So 800,000 shares is great. And then sort of as bonus points, we look at yesterday's volume, and I think the previous day was something like 100,000 shares, 150,000 shares. So very light volume in the previous session. That helps kind of create that big imbalance. Number 7, recent reverse split. And this is a check, recent reverse split. And then I'll just do number 8, near all-time lows. And this was also a check that it was near all-time lows. So all of this for me set up to the point where I was like, yes, this is the right type of stock for me to be considering today. All right, so now I'm ready to take my first trade. Okay, so the stock meets my criteria just from a stock selection standpoint. So once we do stock selection, that's when we're moving on to step 2, which is doing our fundamental analysis, analyzing the news catalyst. And that can extend all the way to analyzing SEC filings, reading the filings, and digging a little bit deeper, and then going into technical analysis. Now, when it comes to the filings, so what I typically do on this is I'll check the most recent quarterly filings to check the most recent float. This was as of May 13th, 2024. So I check the float, and then I know, okay, if it's lower, it's most likely because of a split. I can also check the balance sheet quickly and see how much cash they currently have. This is in, it's not in thousands, so this is $300,000. So $1.2 million in assets, and then I look at their in current assets here, and then including prepayments, which is good, prepaid expenses. Then I look at current liabilities. I look for any long-term debt. What we know right now is that interest rates are very high. So for these companies, refinancing debt is costing them a lot of money, and it's also costing them a lot of money to service debt. So they're more likely to sell shares rather than take on debt. And if they're going to sell shares, that means a secondary offering could be coming. So then I got to check to see what their profit loss is. So for this last 3-month period, 90-day period, they had a loss of 1.7 million. So now it's like, okay, this is going to be a problem. It doesn't appear that they have the capital to sustain those losses without raising money. So then we can go back and we look to see if they have a shelf registration. And we see that they do have a shelf registration. A shelf registration in S3 gives them the right to sell more shares on the market. So when these companies want to sell shares, they file these registrations, which puts all existing shareholders on notice that this is a company that needs to raise money and may go ahead and raise money. And what that would do is it would dilute the value of your holdings. Remember in that example of the float being 50,000 shares after the 100-to-1 reverse split. So if you owned all 50,000 shares, you would be the entire owner, basically the company. And then all of a sudden they say, hey, we're going to sell another 5 million shares. They just diluted you by like a crazy multiple. So you're now not a big owner. And these companies will do that, but they have to have this notice out if they're going to do that. That puts you on notice. So then we've got that, and then we've got the news from Friday that we had out here. So we've got that, which is fine. All right, so we do kind of like an initial cursory look there. And what we can tell is that this is a company that appears to be in need of money. And there's only so many ways they can get that money. Now, of course, not being someone who works at the company or is an insider, it's really a guess as to when they may decide to raise capital. Maybe they'll do it today. Maybe they won't. Maybe they'll go a couple weeks without raising capital. We don't know, but the fact is we have this risk that this could happen, and no better time really than the present when a stock is up, a couple 100% and has a lot of volume, because that would create the liquidity needed to sell shares, because you need volume. You need people to buy those shares if they're selling them on the open market. So I do that brief look of a bit of fundamental analysis, and then I get into the technical analysis. I pull up the daily chart and I ask myself, are we near all-time lows? Yes, we are. Where's the 200 moving average? 200 simple is at 4, 200 exponential is up around 11. So do we have a lot of room to squeeze up there before resistance? Absolutely. All right, do we have any recent high volume candles? A little bit right here. And this is a red candle, so yes. And before that, yes. So a couple of higher volume red candles that occurred following the reverse split. It's not a super recent reverse split. We've seen others that were more recent that were easier to trade, so that's also noteworthy. The reverse split was about 6 months ago. All right, so based on technical analysis of the daily chart, where do we have nearby resistance? Nothing in the form of moving averages, but perhaps something there at about $1.30. And then above that level, we've got room up to about 232. So the way I analyze these charts is I look to the left and then I look up and I look for nearby resistance. So here I was looking left and up and I saw, oh, right there, about 127-ish. And then left and up, 232. And then above that, left and, these areas. But we're a ways away from that right now, so I don't have to get into that detail. So the short term is we have a good amount of room before we run into nearby resistance. Our chart from after hours, a nice spike up, a micro pullback, which you'll learn about if you download the micro pullback strategy PDF, another move up, another pullback, another move higher. Then it stalls out and starts to sell off going into the close. Pre-market 4 a.m. opens and sells off, dips down to about 80 cents and then begins to curl and pulls back and curls and pulls back and curls. And you can see these pullbacks were getting bought up. Each time it came down to these levels of support, it bounced and pushed higher, which is great. And it's back down in that area right now. So then I'm pulling up the 1 minute chart and I'm thinking, all right, where can I take a trade on this stock? I know that this one made a big move on Friday. I know that it's our leading gainer in the market. I know that the float is less than 1 million shares, which is not very common with a penny stock. To be honest, they don't usually have floats that are that low. So this is a pretty interesting situation. And as I saw it right here, I thought this might be the one. So I pull up my Thinkorswim account. So now we're going to move from step 2 to step 3. So step 2 is doing the technical and fundamental analysis, and then step 3 is executing the trade. Now, in this case, I traded my main account, TGL, but I also traded it in my Thinkorswim account. And Thinkorswim is the primary discussion here. So in Thinkorswim, you'll see that this is interesting. I've got TGL here listed twice. TGL, $471, TGL, $157, $629.12. That's pretty good. Well, the problem is it's Monday morning. So I shut down my computer over the weekend, and then I launched my computer this morning. And when I first logged in, I was in my standard Roth IRA. And so I pull up TGL right here, and it's sitting right at about 95 cents. I say, you know what? I'm going to buy 8,000 shares of this. 2 orders of 4,000 shares. Send them out. So I bought 8,000 shares, got filled a little over 95 cents, 96 cents. It goes up to $1, up to $1.05. So I was up for a second about almost 10 cents a share, not quite, 8 cents a share. It comes back down. I take my profit. And I'm like, not bad, right? $471. That's not bad at all. And then I said, wait a second. Did I switch to the right account? And I go up to the top and I realize at that moment, no! This cash account, Fcash, is the cash account that I'm using for the small account challenge. This is the one that I'm supposed to be trading in. This is the account that has a current balance of $16,900. Well, thanks to today's profit. So then with disappointment, I realized, oh my gosh, I just got my first trade. And it was a good trade, $471. And it was in the wrong account. That other account that I have is above $25,000. It's not a small account challenge. Now, I still only took 8,000 shares, which is, I still was able to afford that in both accounts, but nonetheless, it doesn't count. So I switched to my challenge account here. And when it came back up right here, I got back in. So I got back in right here and I got what ended up being only a very small winner. And I was kind of disappointed about that. I was like, well, of course, because I got in a little high. I didn't get filled as well as I wanted to. And then it sort of stalled out here. So I only ended up making $157 in my small account. And then it kind of goes sideways here. It goes at the open, but at that point I had already used all my buying power. KAVL pops up and I see KAVL. And when it first popped up at $1, right back here, I was like, oh my gosh, this looks good. I want to get in right here at $1. I couldn't. I'd already used my buying power for the day. So, that's the luck of the draw. This was at 9 a.m. that this happened. So I ended up trading KAVL in my main account and making $2,300. I ended up losing $8.71 in my main account on TGL. And nonetheless, it's a green day, 3,593 in the main account. And it's a green day in the small account as well. So it's no big deal, but a little disappointing that it's not a bigger green day. However, the goal here is to be consistent and to capture those profits. And I successfully did that. Although the gain wasn't as big as I would have liked, I still am walking away with profit. And if we take a step back, it's focusing first and foremost on the right stocks to trade. Now, even trading the right stocks, as you can see here, I might still have losers. But if I focus on the right stocks, typically the losers will be small relative to the size of the winners. And if I'm trading the right stocks and the right setups, my accuracy will be higher. Now, the stock and the setup are important. You need to have the right stocks, but then you need to have the right setup. And the first setup on TGL was really a nice one. That was a perfect entry. So let's pull that back up. So TGL at 95 cents. It was a great entry because the risk was very well established. So with this entry right here, what do we have? We've got a high of 94 cents right here, and we've got a low of 90 cents. So I'm risking about 4 cents per share, which on 8,000 shares is $240. So $250. It's not a big winner. I can handle that loss. So I've got my 4-cent stop there. Now it's pre-market, so it's not a live stop order, but it's a mental stop. So I've got my mental stop out on this. I'm in there at 94 cents, and we get up to $1.04. So a 2-to-1 profit to loss ratio on a setup that I'm probably going to trade with 65-70% accuracy. I'm going to be pretty confident on that setup. Now, this continuation up here, this is a little riskier. Buying this previous break through the high, that's a breakout trade. That can work, but it can also reject. So there's a little bit more risk on that. It ended up squeezing all the way up to $1.18, and I didn't sell it up there. I was like, let's see if this squeezes higher. But then it dumps back down right here. It pops back up, and then it dumps back down, and I finally bailed out. So this one, look, it was still a winner, but it wasn't the big winner that I kind of thought it would be. And this was a little bit of a riskier setup. On KAVL, my trades on that one, again, buying these first pullbacks. So we'll pull this one up on the 10-second chart here. So KAVL, I was taking my first trade on this right here. So break of $1.10. And that's a very similar setup to TGL, where it's the break through the double top there. Breaking the double top from $1.10 up to $1.30. It pulls back, and then I bought a dip off of $1.10. Why? $1.10 was previous resistance. That becomes support right here. That's part of technical analysis, the language of technical analysis. And this is a language that once you learn it, once you understand how to read your charts, you're going to see these buy and sell signals. And you're going to realize this is a spot to buy the dip if it can get back above and hold this level. Now you're in there, comes back down, back up here, and then it pushes higher. So I kept trading it until I stopped right at about it was about $1.50. And then I was like, all right, that's enough. I don't want to push my luck on it. So $2,300 is good. It's a lower price stock. And one of the challenges with these is that, it's moving, but in percentage, it's moving nicely. But in cents per share, it's not moving as much. And since it is now over $1 to buy 10,000, 50,000, 100,000 shares, you're risking, that it's going to drop 3, 4, 5, 6, maybe even 10 cents. Because now you're at the price range where you can get those big moves. It's great when it's going up, but it's not so great if you get in and you catch that flush going back down. That's when it can be bad. So I had to kind of manage my share size on that, but was able to get a couple nice trades. And then at the open, of course, it pushed a bit higher. But also noteworthy that at the open, this started to get a bit more crowded and choppy. Pops up, halts down. Halts up once, twice, and then drops again. Halts down. Squeezes back up, drops back down. squeezing back up here, and then dropping back down. So one of the things that I have found is that these tend to be the cleanest on the early side, which is the first sort of section of the move. When the MACD, the moving average convergence divergence indicator, when this first opens up and until it first closes, that's the cleanest area. TGL, unfortunately, this move began after hours. So this right here was the first move when the MACD was open, and then that was it. This morning, this was the first move sort of the day when it was open, and I did take that kind of second trade here, and that was a riskier move. A riskier move on what was the most obvious stock at the time, so you can offset the risk with that, but still a little bit riskier. Now, after you've taken all of these trades, right? So after you've taken your trades in your small account, what you want to do is you want to make sure, and it doesn't matter if you're what account size you're in. You could be in a small account, you could be in a big account, but one of the things that's really important is that you're analyzing all of your trades. So what I like to do is I take my trades and I export them. So I'm going to show you how to do this. So export to file. So that's going to be .csv. So you export all your trades, and then you can go over to whatever software you're using for your analytics, and you can import the trades. So now I'm going to go to Thinkorswim right here. This is TraderView software, and I'm going to type in Thinkorswim. I'm going to add a tag so I remember it. There we go. Oops. Oh, come on. Add tag. There we go. And then we're going to just pop that file right there, right here, and we will import these trades. So now it's going to import these trades right away. And now I can go back here to reports. We can now sort just by the Thinkorswim tag. And now we can see today being day 6. So 1, 2, 3, 4, 5, day 6. So detailed right now, average winners, accuracy is 85%, which is great. Average winners, $671. Average losers, $154. That's not too bad. And I'm making progress. Goal is $25,000 in the account. I'm growing it slowly and steadily. The account is currently up close to 30%, and that's over the course of 6 days. So, getting 3, 4, 5% a day. The only way I'm going to be able to grow the account that quickly is by trading stocks that are moving or that have the potential to move, 20, 30% in one day. And I know that I'm never going to capture the entire move. I'll never get a perfect entry where I get the exact lowest price and then the exact top of the move. But if I can capture a sliver of it and I can do that consistently, then I'm going to walk away each day with a little bit of profit. And one of the nice things about only being able to take one trade a day is that, if I take that one trade and it's a loser, then that's it. I'm done for the day. I'm not going to be able to start to spiral and take trade 3, 4, 5, 6, 7, 8 back to back and get more and more frustrated. I'm just done. I could take one trade a day. And that is the small account way. One trade a day, ideally one entry, one exit, get green, shut it down, come back, do it again tomorrow. You do that 10 days in a row. And this is the challenge that I give a lot of our members. As part of our Warrior Pro curriculum, we have a trading plan. It's a detailed plan that we put members on, and it walks them through the time of day to trade, where to get in, where to get out, the type of stocks that I focus on. It's a very clear walkthrough of the strategy that I'm trading every single day. And the first goal is to have a green month and to do it by taking one trade a day. So I asked members to send me their metrics of the one trade a day challenge, and these are some of the metrics. Now, some traders didn't trade every single day, but a lot of them did a really good job focusing generally on one trade a day. This is a very disciplined one trade a day P&L. So if you want to learn more about my strategy, I encourage you to check out the links that are pinned to the top of the comments, where you can download my small account strategy and my micro pullback strategy PDF, my stock selection PDF, and where you can download my Thinkorswim layout. And if you'd like to do a 2-week trial at Warrior Trading, you're welcome to check that out as well. I'll put links in the description for a 2-week trial, and I'll put a link in the description for a free class that you guys can watch. So those of you guys that just want to watch another class to learn more about how I trade, you're welcome to check that out as well. I want to thank you as always for tuning in. I'll remind you as always that trading is risky. My results aren't typical. So manage your risk, take it slow. And I hope you are subscribed to the channel for more episodes about trading strategy just like this. And we'll see you for the next upload real soon.